Right then, let's talk about money management. So money management is obviously very closely tied to risk management, okay? But it generally just refers to how much you're going to risk per trade, when you're going to withdraw it, and how you're going to manage multiple accounts or instruments, okay? So let's just keep this nice and simple. Now, most sort of strategies and advice around money management is to risk a percentage. So typically people are recommended to risk 1% or 2% or 5% or whatever their favorite number is. You risk that percent per trade. Now that's all well and good for stop loss trading. However, if you use a strategy where you're going to average, you're going to add more trades, it's not really that simple, okay? So a better way to do it is to look at how much balance you have and have a sort of lot size per 1,000 of balance. And that also needs to change per instrument and also take into account the settings that you intend to run. So let's just do an example and this will become easier. So the first point then is, don't just look at what you can make. That's the biggest mistake you can make, is people will say, okay, I'm going to put on a trade here, and if it goes to my TP here, I'm going to buy, I'm going to make 1%. That's totally the wrong way to look at it. What you should be looking at is, well, what if it doesn't go to my TP? What if it goes to the next level and I buy again? And then it goes to the next level and I buy again, and it goes to the next level, I buy again, it goes to the next level. Your losses are getting exponentially bigger. So don't just look at what you can make, look at what you can lose. That is the first big part of money management, is don't just think, well, when it hits my TP, I'll make 1%. What are you going to lose if it goes against you and you have to cut the trade? So that's the first thing you've got to consider. Now then, an easy way to figure this out is to go on a demo account, or if you're going to do this live, enter the smallest lot size that you can, okay? So on Forex, that will usually be 0.01 lots. On the indices, it will be very different at each broker. So my broker, the limit is 0.10. And at a lot of brokers, it's actually one. It's one whole lot on the Dow or the NAS or the S&P. So it differs by your broker. And also, that actually depends how much money you've got in the market as well, because they have different numbers of contracts per lots. So it's entirely possible that I can enter 0.1 lots and be in at the same risk as someone at another broker who's risking 1 lots or 10 lots, okay? So have a look at how your brokers set it out. Go on a demo account, enter the smallest lot size that you can, and see how much each zone is worth. So when I'm talking about a zone, if this here is a 50-point level, from this level to this level, that is one zone. So this might be worth $10, it might be worth $100, $1,000, $10,000. You need to work out what this is worth at the smallest lot size you can put on. And once you know what that's worth, and you know how far an instrument typically moves and how many trades you're going to have to add, or how many trades you're willing to add, then you can work out what you can lose, okay? So don't just look at what you can make, look at what you can lose. This is literally the most important part of your money management, is figuring out how much you have in your account, how much leverage is going to be used, how far the market typically moves, what you're happy to withstand when it moves against you, and what you're probably going to make if it hits your TP. I can't just give you some flat figure and say, risk this amount, do that. That's just totally the wrong way to go about it. All of you watching this will be very, very different. Some of you will just absolutely go from it from day one. You'll ignore everything I say. You'll risk massive amounts and you'll get very different results to somebody else who's much more cautious, who risks the smallest amount possible and uses very mild recovery settings, okay? So you kind of need to figure this out for yourself. I've told you what I do. I typically start at the lowest possible lot size. I see what the risk is. I see what the reward is. If I'm not happy with that, I'll raise the risk a little bit and I'll keep testing. And then eventually I get everything on a live account. Once I've got it all figured it out, I do everything on demo. Instruments are also very, very different, okay? Whether it's Forex or whether it's indices, even the Forex pairs differ enormously, okay? Think about Euro Pound compared to Pound Jappy. One of them, you're going to spend a week waiting for this to happen, for it to go 1.5. Another one, you know, it's going to do that in a day. So again, figure out what you need to put on for each one. Right then, another important thing to consider is that you need to adjust your lot size according to the market. Now, not just the market that you're trading, but what is the market doing? So for example, we're currently on the Dow Jones, okay? Now, depending when you're available to trade, let's say that this is what the Dow Jones looks like at 2:30, and it genuinely is. It's flying. It's all over the place. What does it look like in the Asian session? Well, it looks like this. Okay, so this is pretty much the Asian session. It's barely moving. You sometimes get like a little creeper. It will basically creep up one zone. It'll take the whole night to get there. Something like that. Depending on which bit you're trading, depends on the lot size, depends on what you want to risk. In this period, you should definitely reduce your risk. The market's moving really fast. It's moving really far. It's going to trigger in lots of trades, potentially lots of drawdown, also lots of profit if you do it right. In this period, the market is barely moving. If this is the bit that you have to trade, does it make sense for you to risk the same amount as the guy or the person who's trading this? No, of course it doesn't, and vice versa. So depending on the behavior of the market at the time, also, that's a consideration for your money management, okay? Then you need to lower your lot size for multiple instruments. If you intend to just trade one single instrument, okay, then you can probably have a slightly higher lot size than somebody who is trading 2 or 3 or 10 instruments, okay? The more stuff you trade, the lower your risk needs to be, because you're essentially having this across multiple instruments, which means you're spreading yourself, or your account, you're spreading it really thin, okay? So you need to lower your risk for that. That's another important consideration. What comes along with that, with multiple instruments, is that there will be correlation, okay? Instruments tend to move in the same way. There tends to be a relationship there. This is called correlation. You need to half your lot size. This is what I recommend. You need to half your lot size for highly correlated instruments. What do I mean? If we have something like the pound US dollar and the euro US dollar, put those two charts side by side, they're very, very correlated. If you trade, let's say, £10 per zone or $10 per zone or whatever, and you're trading both pound US dollar and euro US dollar, you've essentially just doubled your risk on the same trade. It doesn't quite work like that, but it kind of does, okay? They will move in the same way overall over longer periods, like on the daily chart. And therefore, the most sensible thing to do if you insist on trading two highly correlated instruments, another good example would be if you traded the Dow Jones and the Nasdaq, they are highly correlated. I would split my risk between them. Instead of risking $10 per zone, I would do $5 per zone on each, okay? So you split it 50-50 between them. That's a good way of doing it. Another thing to consider is when you're going to withdraw and reset the balance. Now, a lot of the profit from trading comes from compounding. That means you take your winnings and you reinvest them and you trade it again. And especially if you're doing some kind of percentage-based system where you're risking 1% per trade, even with you doing an amount per 1,000 lots, you are essentially, that is still a percentage if you think about it, you're just doing it per 1,000 instead of per 100. And so it's roughly the same thing. Now then, if you just compound your account forever with a system like this where you'll typically win and win and win and win, eventually the market will go too far, okay, and then something like this will happen. So this might have been your huge winning period, and you'll see this loads and loads of days. You'll have days of 10 winners or 20 winners if you trade the entire day. And, you know, you might get 2 or 3 days like that in a week. And then one day there's a news event, bang, it just shoots off and you have to cut a trade and you give back some of your previous day's winnings or that morning's winnings or whatever. In other words, you take a loss. If you've just kept compounding the account and your trade sizes have been getting bigger and bigger and bigger, this loss that's just happened can potentially wipe out quite a lot of what you've already made. Now, if you set yourself a target and you withdraw, that resets your trade size. So let's say Monday, Tuesday, Wednesday, you have days like this. It just keeps retracing itself. You just keep winning, whether you're buying or selling, you just keep winning. And you've made 50%. And then on, Thursday, you withdraw the 50%, you're back at your original account balance, you're back at sort of a lower amount. And then that happens, you cut some trades, you're down on Thursday. Friday, you make it all back, you're back at square one, you've withdrawn your profits for the week, job done. That's 2 very different outcomes. In one of them, you've got a load of profit in the bank and your account's back where it started. In the other one, your biggest loser was at your biggest position size because you kept compounding the account and you took a loss and you wiped out days and days of profit that's going to take you a while to make back. So you get 2 very different results. Again, there's no real percentage. This will be different for everyone. People are like, at what point should I withdraw? I can't answer that. How big's your account? How many instruments are you trading? How often do you trade? How much profit have you got? Again, this is totally different for everyone. But what's important is that you do need to not compound forever. Take the money out, reset the balance. When you reset the balance, you reset the risk, which means you lower the risk, okay? Because remember, that day is always going to come when the market just flies in one direction and you'll have to cut something. Finally, high and low risk accounts. What does this mean? It's fine to have one account when you start with, okay? But what you do is as you build up profit, okay, let's say you double your account, withdraw it and reset it, and you then have two accounts of the same balance. And they don't have to be the same balance. You could actually pocket half of the profit. And then let's say you have a $1,000 account. You turn it into $2,000, you split that into two accounts, you put $500 in your pocket, $500 into a second account. You then have a $1,000 account and a $500 account. Your $1,000 account could be your low risk. You continue to trade sensibly. The $500 account, you could trade on a higher risk. You could use a different strategy. It doesn't have to be this one. You could start trading with a stop loss. You could wait for turning points at the market. You can do order blocks. You can do pin bars. You can do whatever you want. It opens up a load of avenues for you, okay? You can trade in a completely different way, but by having high and low risk accounts, it gives you more options. You can transfer money between the two. Every time a low risk makes a profit and you withdraw, you can transfer it into the high. You can transfer profits from the high risk into the low risk. You can do whatever you want with it. But this essentially is account management, and it is the best way to do it. I personally have high, medium, and low risk, and I'm constantly moving money between them. Sometimes the high risks, they are high risk. Sometimes they blow up. It's nice when they blow up that it was only profit, okay? And that you'd already transferred lots of profit from the high risk into the low risk, and you're only ever losing a small portion. This is really the secret of making money long term with trading, is keeping hold of what you win. So many people are driven by greed that they do not do these last 2 points, okay? If you never reset the balance and reset the risk, and you never withdraw the profits and then use a high risk account to risk only profit, you're going to give back everything you win all the time, and that's a frustrating existence. So please focus on these last 2 points, okay? But this is money management, and it's very, very important that you make a plan and follow it.